Warren, you are a big advocate of index investing and of not trying to time the market. But by your having Berkshire hold such a large amount of cash and T-bills, it seems to me you don't practice what you preach. I'm thinking that a good alternative would be for you to invest most of Berkshire's excess cash in a well-diversified index fund until you find an attractive acquisition or buy back stock. Had you done that over the past 15 years, all the time keeping the $20 billion cash cushion you want, I estimate that at the end of 2018, the company's $112 billion balance in cash, cash equivalents, and short-term investments in T-bills would have instead been worth about $155 billion. The difference between the two figures is an opportunity cost equal to more than 12% of Berkshire's current book value. What is your response to what I say? And I forgot to say, the question is from Mike Elzhar, who is with the Colony Group located in Boca Raton, Florida.
That's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that is an alternative, for example, that my successor may wish to employ, because on balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you were working smaller numbers, it would make a lot of sense. And if we're working with large numbers, it might well make sense in the future at Berkshire to operate that way. You know, we committed $10 billion a week ago, and there are conditions under which, and they're not remote, they're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, we'd be capital very well deployed and much better than in an index fund. And so we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood, and they will come when other people don't want to allocate capital. Charlie, what do you think about it?
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 20/20 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. We don't have to. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. And they suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Plus timber and a whole bunch of things.
What?
I mean, plus timber and I mean.
Yeah. We're not going to change.
No. We do like having a lot of money to be able to operate very fast and very big, and we don't. And maybe we won't. We know we won't get those opportunities frequently. I don't think. Certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold, and all you have to do is go outside. But we don't know when they will happen, and we have a lot of money to commit. And I would say that if you told me I had to either carry short-term treasury bills or have index funds and just let that money be invested in American generally, I would take the index funds. But we still have hopes. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money from anybody that buys our stock somewhere around intrinsic business value to begin with.